The housing market in the entire country is going through this weird shift. We have some areas selling for above list price very quickly, while other areas inventory is absolutely skyrocketing. I did a video on Texas recently, and you're starting to see inventory at the highest levels it's been in almost 10 years, as well as almost 40% of homes having price reductions. Check that out on my channel if you're interested in the Texas housing market. And then you have states like Florida, which is also seeing inventory skyrocketing. But California inventory is still below the historic average back in 2019. You still need around 25,000 homes to hit those levels. So what's going on in the actual housing market? Where do I expect house prices to go? And this idea that we're potentially going into a housing crash, and is this actually possible? Well, today I want to dive into some of the data, look at what the median home value has done relative to the unemployment rate, as that has been sort of increasing for the last year, as well as take a look at mortgage rates and my expectation as to where they're going to go and how that will impact home values. If you like this video, subscribe for more, and let's get straight into the data. So the median home value in the US, if you weren't aware, did peak in 2022, right around $442,000. This is when the Federal Reserve started the fastest rate hiking cycle in history, so it's no surprise that the housing market sort of stalled. But what's interesting is you had part of the country significantly outperforming other areas. Where I live, for example, in Orange County, California, prices are up 15 to 20% during this same period of time, where the overall market in the US is down around 5%. So it's interesting to see some areas which are very desirable compared to others still doing very well, as buyer demand has been skyrocketing in parts of the country. So if we look back in 2020, when this huge price rise started, when mortgage rates were the lowest they've been in history at 2.5%, 3%, which is arguably one of the best times to buy a home. And looking back, I think a lot of people who didn't buy over here and were falling for this narrative that house prices were about to crash probably regret it, because if you stayed in a rental, you had your rent increasing 5% every year, when you could have honestly owned a home for very minimal price difference compared to renting at the same time. I know a lot of people who bought with 5–10% down, and their mortgage payment would have been less than the equivalent home in terms of renting. So we're in this period of time now where I think a lot of buyers are kind of waiting for mortgage rates to make a decision. If you look at the 30-year fixed mortgage rate, this is when the Fed started the fastest rate hiking cycle in history, going from around 2.5%, 2.6% in December of 2020, all the way up to almost 8% in a matter of 2.5–3 years or so, which is, as you can see, looking back at this chart, the only time that came close to this was the inflation crisis that we had in the 70s and 80s that brought mortgage rates to 18%. Thankfully, this hasn't happened, and I don't foresee this happening. My opinion on where mortgage rates are going to be headed is quite simply based on the unemployment rate. I think the Fed is looking for the unemployment rate to increase, get to 5–5.5% before they're going to cut rates drastically. Because what you don't want is a huge rise in inflation and then they cut rates too soon, and then inflation just comes back even worse like it did in 1981, which caused mortgage rates to skyrocket again. Now, if mortgage rates went to these levels, the housing market would absolutely fall off a cliff, because everyone knows we're in this environment where owning a home is not affordable for a lot of people. You have to make a large amount of money in most areas to buy a home compared to renting the equivalent home. Yet you're still seeing a lot of demand in pockets of the country. So as far as where mortgage rates are going to be headed, I think if we have the unemployment rate increasing, you're going to see mortgage rates declining. We've already had a pretty decent downtrend in inflation for 2025. We're almost at 2%. I think in the recent numbers it was 2.4%, and the Fed's target is to hit around 2%. Now, obviously, the unknowns with this is going to be tariffs, whether or not that significantly impacts inflation on one data point or if it's going to be multiple months in a row. Tariffs should just increase the cost of goods for 1 month, and then we should have a continuous downtrend with inflation. Also keep in mind that inflation When you look at home values, 2/3 of the inflation number is the housing market. So if we're seeing mortgage rates stall out like they've been for the last 3 years, that could potentially put downward pressure on home values, which in turn would cause inflation to decline because it makes up so much of that inflation number. But when it comes to how low mortgage rates are going to go, I think we're probably going to see multiple rate cuts in the second half of 2025, and that could get mortgage rates to below 6% before we start next year. Now, in all honesty, I think rate cuts likely continue into 2026, where we have 5.5, potentially low fives before the middle of next year, and that will open up the door to a lot more buyers to step into the market, because I personally know a lot of people that are waiting for lower mortgage rates before they even start looking at homes again. Even though you have places like Texas and Florida where inventory is skyrocketing, there's still a lot of buyers that just want to wait and see what happens, wait and see if they can get mortgage rates coming lower before they start writing offers. So I think areas are going to have a lot of price reductions if inventory is skyrocketing. Now, when it comes to the unemployment rate, this is what it's been doing. Unemployment has increased from 3.5% to 4.2%, not much. But you can see if the unemployment rate gets out of control, it very quickly can increase to numbers that cause a recession. Now, I don't know if a recession is going to happen, but if the unemployment rate does do what it did here, just absolutely skyrockets, we're going to have a recession. And remember, if unemployment gets out of control, it probably doesn't matter what mortgage rates do. House prices are going to decline. So if we look at inventory in the overall country, it has been increasing since 2022, which is good. We had 350,000 homes on the market back here, and now we're almost at 1 million active listings. But so much of this is made up by Florida and Texas, which is unbelievable that a couple states are making up, I think it's 1/3 of all the listings in the country are from Florida and Texas. I'll have to do a separate video on that. But as far as home values goes and my expectation for the housing market, I think the more likely scenario is that we just trend back to a neutral market with modest appreciation. Now, you'll have parts of the country outperforming others. Desirable areas will continue appreciating as there's still a lack of available homes for sale. If you look at the month supply of inventory, you have 9 months of available supply right now. Sorry, eight months of available supply right now. And we did get to pretty high levels in September of 2022, where you had 10 months of available supply. A lot of that is made up from not enough buyers stepping into the market and inventory increasing. So, I mean, we kind of got to these levels that we saw in 2008, where you had 11 months of supply. So if this carries on increasing, it's in a pretty sharp uptrend right now. If this carries on increasing, you're probably going to see more price cuts around the country. And then that would likely cause home values to decline for a couple years. Remember, the housing market moves very slowly. We had an enormous interest rate hiking cycle starting in, I think it was 2021, and it really took a year or two for house prices to start declining from that rate hiking cycle. The housing market moving forward is just going to be extremely location dependent. You can't just have a blanket statement like house prices are going to decline or house prices are going to rise. It's just going to be based on your area. And how to know what the market is doing, a good indication is the month supply of inventory. Remember, no matter what the housing market is doing, 10 years later, home values are always more expensive. Even during the 2008 financial crisis, when it was buy one, get one free in a lot of areas, when the house prices dropped 50%, 10 years later, they were way more expensive. So all of this needs to be considered. And of course, the monthly payment is one of the most important things that you need to consider when buying a home. You don't want to get yourself into a situation where you can't really afford the monthly payment or it's having a significant impact on your quality of life. But let me know your thoughts in the comments. If you like this video, subscribe for more, and I'll see you next time.